In this lecture, we introduce the classification of income for purposes of international taxation of electronic commerce. The topics covered in this lecture are as follows. The U.S. income classification rules for international taxation, special U.S. tax rules for classifying transactions involving software, other digital content, and cloud transactions, the foreign tax rules for classifying transactions involving software and digital content, and the OECD rules for classifying online services and digital product sales for tax treaty purposes. We also look at the effect of classifications on the source of income in tax treaties. Let's start by taking a look at the U.S. rules for classifying income for purposes of international income taxation. First, a reminder of why we care about income classification. As discussed in the text, at the heart of international taxation is the source of income. For all countries, the source of income determines the country with the right to tax that income. In addition, for U.S. tax purposes, the classification of income as foreign source under U.S. tax law determines whether a taxpayer will receive a U.S. foreign tax credit to offset foreign taxes paid on that income. In sourcing income, we apply different rules to different types of income. Therefore, it is crucial as a first step in figuring a company's tax liability to classify the income resulting from international transactions. In this lecture, we're going to discuss the classification of many types of income. All of these classification rules are discussed in the text. Here's what we'll be looking at. Sales of inventory, rentals and leases, sales of intangibles, licenses of intangibles, software transactions, other digital content transactions, and cloud transactions. Let's talk about sales of inventory first. It should be fairly simple to determine when a company is selling inventory, if that inventory is tangible personal property. Such inventory can include hardware and softcover books and box software. More difficult is digital content, such as downloaded software and digital books, audio, and video. We will discuss digital content later in this lecture. For now, if there is a sale of a copy of a digital item and there is no transfer of a copyright right, then there's probably a sale of inventory. Here's an example of a sale of digital content constituting inventory. Webco sells downloaded books, videos, software, and music. The buyer retains permanent use of these items in exchange for a one-time payment, and the buyer does not receive any copyright rights. There is likely a sale of inventory. Let's turn briefly to the more difficult question of rentals. There is a rental if a customer obtains control of an item. The customer does not acquire any intellectual property rights, and that control is temporary. In online transactions, especially those involving software, there is a question about whether the customer has obtained a service from the vendor, or the customer is renting property from the vendor. Following are rules that help us differentiate between a service and a rental. In the case of software, and potentially any type of digital content, a transaction probably involves a rental, not a service, if the customer is physically in possession of the software, the customer controls the software, the customer has an economic or possessory interest in the software. The vendor does not bear any risk of substantially diminished receipts or substantially increased expenditures if there is a non-performance under the contract. The vendor does not use the software concurrently to provide services to other users, and the total price does not substantially exceed the rental value of the software for the period of use. Here's an example of a rental of software. Webco makes available software X, which is used to control warehouse operations. Customers download the software and then pay a quarterly fee to continue using the software. The customer receives quarterly software updates. If the customer stops paying the quarterly fee, the customer cannot legally continue to use the software. In this case, based primarily on the fact that the customer is in control of the software during the period of use and is not using the same copy of the software concurrently used with others, the transaction is deemed a rental. Now let's talk about sales of intangibles. Intangibles include intellectual property such as copyrights, patents, trademarks, trade names, and know-how. There is a sale of an intangible if all substantial rights in the intangible are permanently transferred. As an exception, if the price of the intangible is based on the use or productivity of the intangible, then the transaction will be classified as a license. Here's an example of a sale of an intangible. Webco owns all of the patent rights in Patent X. It sells all of those rights to Fore & Co. for a fixed price of $100,000. Ordinarily, this transaction will be classified as a sale of an intangible so long as the payment is not based on the use or productivity of the intangible. Next, we discuss the license of an intangible. There is a license of an intangible if the owner of the intangible permits another to use a portion of the rights in the intangible in exchange for payment. In addition, as noted above, a purported sale is classified as a license if the payment for an intangible is based on the use or productivity of the intangible. Here's an example of a license of an intangible. Webco owns all of the patent rights in Patent X. It sells all of those rights to Fore & Co. for a price equal to 10% of the gross revenues earned by Fore & Co. from use of the patent for a period of 10 years. Because the price is based on the use or productivity of the patent, the transaction is deemed a license. In addition to general rules for income classification, the United States has extensive special rules for the classification of transactions involving software. As discussed in the text, there are U.S. regulations at Reg 1.A61-18 that are devoted to the subject of classifying transactions involving software for purposes of international income taxation. Under these regulations, software transactions are classified in 6 different ways, and here are those classifications. The sale of a copyright right in the software, transfer of a copy of the software, that is a transfer of a copyrighted article, the provision of services for the development or modification of software, the provision of know-how relating to computer programming techniques, the lease of software, that is a lease of a copyrighted article, and the license of a copyright right in software. The first transaction is a sale of a copyright right in software. There is a sale of a copyright right in software where there is a sale of a copy of a software program together with all of the substantial rights to exploit the software copyright commercially, such as by reselling the software, licensing the software to others, or creating new software that is derived from the software received. And the price is not based on the use or productivity of the software copyright. There is also a sale of a copyright if any of one of the 4 copyright rights is sold. The 4 copyright rights are the right to make copies of the software for purposes of distribution to the public by sale or other transfer of ownership or by rental, lease, or lending. The right to prepare derivative software based on the copyrighted software. The right to make a public performance of the software, or the right to publicly display the software. Here's an example of a sale of a copyright right. Webco owns all of the software copyright rights in SoftwareX. It sells all of those rights to Four & Co. for a fixed price of $1 million. Ordinarily, this transaction will be classified as a sale of a copyright, so long as the payment is not based on the use or productivity of the software copyright. Next is the transfer of a copy of the software. This is the transfer of a copyrighted article. The transfer of software classified as a transfer of a copyright right is a transfer of a copy of a software program without the right to exploit the software copyright commercially. Ordinarily, this means transfer of the software to be used only by the transferee. In general, where the transferor is in the business of selling software, such a transfer is the equivalent of a sale of software. Here's an example of a transfer of a copyrighted article. Webco owns all of the copyright rights in SoftwareX. It sells a copy of the software program to Four & Co. for a price of $25,000. Four & Co. downloads the software from the Webco website. No copyright rights are transferred as part of this sale. The software is accompanied by a shrink wrap license that permits Four & Co. to install the software on no more than 100 computers, and further provides that only Four & Co. employees can use the software. This transaction is classified as a transfer of a copyrighted article. Now we turn to the transactions classified as the provision of services for the development or modification of software. A transaction classified as the provision of services for the development or modification of software is a transaction involving the acquisition of software by a buyer where nobody previously owned the transferred software. The software is created or modified by a person who never takes ownership of the software. An example is a work-for-hire development contract where a company hires a software developer to create software, and the developer never obtains any rights in the software. Here's an example of services for the development of software. Webco hires DevelopCo, an unrelated company, to write new software to run its website. Under the contract, DevelopCo is to create certain transaction processing software under a work-for-hire contract. Under this contract, all rights in the software are owned by Webco from the inception of the project, and DevelopCo never holds any of the rights in the software. Next, we have the provision of know-how relating to computer programming techniques. This is the provision of services using secret knowledge, know-how, of the service provider, or the transfer of such secret knowledge to the buyer. Here's an example of the provision of know-how. Webco possesses certain secret knowledge regarding website programming techniques. It sends Jones, one of its programmers, to Foreign Co. for the purpose of providing Foreign Co. with that secret knowledge. Jones spends 3 months in country X in Foreign Co.'s offices training that company's employees on these secret techniques. This is a transfer of know-how. Let us now consider a rental or lease of software that is a copyrighted article. A temporary transfer of software that is a copyrighted article in exchange for payment ordinarily constitutes a lease or rental of the software. To be considered a rental, the transfer of the software cannot involve the transfer of any copyrighted rights in the software, such as the rights to exploit the software copyright. In addition, the transaction cannot constitute the provision of services. Earlier in this lecture, we discussed the differentiation between a transaction that is a rental versus one that is a service. Here's an example of a rental or lease of software. This example was discussed earlier in this lecture and is being repeated here. Webco makes available Software X, which is used to control warehouse operations. Customers download the software and then they pay a quarterly fee to continue use of the software. The customer receives quarterly software updates, and if the customer stops paying the quarterly fee, the customer cannot legally continue to use the software. In this case, based primarily on the fact that the customer is in control of the software during the period of use and is not using the same copy of the software currently used by others, the transfer is deemed a rental. Finally, we have a license of a copyright right in software. This is the transfer of the right to use software accompanied by the right to exploit the software copyright commercially, such as by manufacturing and reselling the software to others or licensing the software to others. A license also includes a sale of a copyright, where the sales price is based on the use or productivity of the software. Here's an example of a license of a copyright in software. Webco owns the copyright in Software X. Webco transfers a copy of the software to Manufacturer X, a Country X company. Accompanying the software is a transfer of a license granting Manufacturer X the right to reproduce and sell Software X. Webco receives a royalty of 20% of the sales price of each copy of the software sold by Manufacturer X. Let's consider the impact of the electronic delivery of software. As discussed in the text, under U.S. regulations, the electronic delivery of software has no impact on its classification for tax purposes. Instead, the most important factor in classifying a transaction is the rights acquired by the buyer. Note that the U.S. software regulations do not apply to digital content other than software. However, it seems clear that the rights acquired will determine the classification of digital content, not whether they are electronically delivered. The OECD agrees that the electronic delivery of digital content has no impact on their classification, and that the rights acquired determines classification. The OECD's guidance applies for tax treaty purposes only and applies to both software and other digital content. Here's an example of electronic delivery. Buyer purchases and downloads a copy of Software X from Webco's website. The buyer acquires perpetual use of the software from Webco, subject to a shrink-wrap license, which buyer electronically signs prior to download. Note the rights acquired and the rights not acquired. These rights tell us how to classify the transaction. The rights are perpetual use, which eliminates both a service transaction and a lease transaction. A shrink-wrap license, which typically prohibits the buyer from commercially exploiting the copyright, such as by licensing the software to others or making and selling copies of the software. This license eliminates a sale or license of a copyright. Having eliminated services, leases, and the sale or license of a copyright, the transaction must be the sale of a copyrighted article. Clearly, this is not a transfer of know-how. Transactions involving digital content other than software are major sources of revenue for online vendors, so let us consider these. Proposed regulations generally define digital content as a computer program or any other content in digital form that is either protected by copyright law or no longer protected by copyright law solely due to the passage of time. For example, digital content includes computer programs, books in digital format, movies in digital format, and music in digital format. A computer program includes any media, user manuals, documentation, database, or similar item if the media, user manuals, documentation, database, or similar item is incidental to the operation of the software. As discussed later, these proposed regulations are not authoritative, but they do provide useful guidance in interpreting existing authorities. Also, as noted earlier, the regulations at Reg 1.861-18 say they do not apply to other digital content, at least not directly. We can, in the absence of other rules, however, apply Reg 1.861-18 by analogy to other digital content. As in all cases where we apply rules by analogy, we do so knowing that the analogous authority is persuasive but not actual authority. If we do so, that is, use Reg 1.861-18 by analogy, then we must classify other digital content based on the rights received. Proposed regulations issued in 2019 would amend the software regulations to apply to all digital content. The regulations do so without changing the substance of the software regulations. So essentially, the current software regulations would apply to all digital content. Here's an example of other digital content. Foreign Co. is a Country X seller of digital books. Buyers in the United States download these books from Foreign Co.'s Country X website. If we apply Reg 1.861-18 by analogy, then we must conclude that these ebooks are copyrighted articles, essentially taxed as sales of inventory. However, we do so knowing that the IRS is free to argue that the regulations at Reg 1.861-18 do not control, and that these sales must be classified in some other manner. If the proposed regulations are finalized, however, then these ebooks would be classified as copyrighted articles. Let us now turn to the classification of cloud transactions. Ordinarily, cloud transactions include access to software and data through the internet. In general, where the customer does not obtain possession of the software or data, such a cloud transaction may be classified as services or rentals. It should be noted that cloud transactions, including online services provided through online access to software, are not described in the regulations at Reg 1.861-18. Using the criteria for differentiating between software services and software rental presented at the beginning of this lecture, most online use of software in a cloud transaction should be classified as a service. The primary reasons are the user is not in control of the software, is not in physical possession of the software, that is, the software is not installed on the user's computer, and the provider allows many users to use the online software concurrently. Here are examples of cloud transactions involving online services. Webco operates a website that provides online access to music. Users can listen to music for free, and they can pay $5 a month fee to obtain premium services, such as creating online playlists. Users do not download any software, and they are not permitted to download any music. Webco is offering an online service. Here's another example of a cloud transaction involving a service. Webco owns all of the rights to Software X, a software program used to do business valuations. The price for use of the software is $195, which entitles the user to perform a valuation for a single company and update that valuation for a period of 3 months. The customer can print as many standard valuation reports and as many valuations using different assumptions of that report as necessary. Proposed regulations were issued in 2019, which would control the definition and classification of cloud transactions. While these regulations are not authoritative, they provide useful guidance in classifying cloud transactions under existing guidance discussed earlier. Let's look at a definition of a cloud transaction. Under the proposed regulations, a cloud transaction or cloud computing transaction is a transaction through which a person obtains on-demand network access to a computer hardware, digital content, or similar services. A cloud transaction does not include access that is de minimis, taking into account all arrangements and the surrounding facts and circumstances. In addition, A cloud transaction does not include network access to download digital content for storage and use on a person's computer or other electronic device. That is, a cloud transaction does not include, for example, the purchase and download or the right to download computer software or other digital content and the perpetual right to use that software. Here's an example of the definition of a cloud transaction. Corp A provides Corp B with access to customer relation management software via a standard web browser, which Corp A hosts on its servers for a monthly subscription fee. Corp B has no ability to alter the software code, and Corp A agrees to make available new versions of the software as they are developed for the duration of B's contract, and to assure servers uptime in accordance with the service level agreement. The transaction between Corp A and Corp B is a cloud transaction because Corp B obtains a non-de minimis right to on-demand network access to computer hardware and software resources of Corp A. A cloud transaction is classified solely as either a lease or the provision of services. For this purpose, a lease includes only the lease of computer hardware, digital content, or other similar resources. The regulations provide rules for classifying a cloud transaction as a service. Any transaction not classified as a service is classified as a leaf. These factors for classification are discussed in the text. An arrangement comprised of multiple transactions generally requires separate classification for each transaction. If at least one of the transactions is a cloud transaction, but not all of the transactions are cloud transactions, the cloud transaction rules apply only to classify the cloud transactions. However, any transaction that is de minimis, taking into account all of the arrangement and the surrounding facts and circumstances, will not be treated as a separate transaction, but as part of another transaction. The foreign country rules for classification of software and digital product transactions are not extensive. When I refer to foreign country rules, I am referring to the local tax rules of the foreign country with the right to tax a software or digital content transaction. We do not know very much about these rules since they are not published in the United States and are not easily available to us. In order to comply with these rules, we need to engage the services of lawyers and accountants in the country in question who are familiar with these rules. As discussed in the text, the most important thing to know is that the rules of foreign countries may not agree with those in the United States. Where they disagree, it is possible to have a transaction involving software or other digital content that is double taxed or not taxed at all. A key thing to know when rules do not agree is the U.S. foreign tax credit can be lost if the foreign country imposes an income tax on a software or other digital product transaction, even though the United States does not deem the transaction to result in foreign source income. Recall that only foreign source income is eligible for the foreign tax credit relief. Now let's briefly examine the OECD rules for tax treaty classification of online transactions. As explained in the text, In 2001, the OECD issued recommended rules on the classification of 28 different types of online transactions. While not necessarily binding, they are one of the most comprehensive sources of guidance on the classification of online transactions. As discussed in the text, the classification rules apply to transactions covered by tax treaties based on OECD model treaties. Because the U.S. model tax treaty is similar to the OECD model, the rules can be applied in classifying transactions covered by U.S. tax treaties. These rules concern themselves primarily with the question of whether a specific online transactions result in business profits, royalties, and in some cases, technical services. Now, you may wonder why the OECD rules concentrate primarily on these three types of income, and the reason is tax treaties focus mainly on these types of income. Under OECD and U.S. tax treaties, income classified as business profits is taxed in a country if the income is attributable to a permanent establishment in that country. Under these treaties, income classified as royalties is taxed in a country if the royalties arise in that country. And finally, under some treaties, technical services are, like royalties, taxed in the country in which they arise.